Before we do, I have a really good in-depth presentation on why I think gold prices are about to emerge in very short shrift, in very short time frame. We're going to
Welcome to Gold Silver Pros.
Everybody, this is 𝘎𝙁𝙊𝙇𝙄𝙊𝙍 with �goldsilverpros.com. This is your market report for Thursday, October 9th, 2023, and a very special one we have for you. At the end of the presentation, I'm going to tell you what I see happening in the wholesale gold market through my suppliers and what we see in my retail shop. I'll have that exclusive report for you. I don't think anybody's really talking about it. But before we do, I have a really good in-depth presentation on why I think gold prices are about to emerge in very short shrift, in very short time frame. We're going to dive right into that, ladies and gentlemen. Stay tuned. This is a great report. Good presentation for you with lots of data. Title of the report is Short Position Dominance, an analysis of swap dealer control over the commodities market and how gold may be ready to emerge. Let's dive right into it. The swap dealers are the bullion banks. For those of you that watch the weekly market wrap-up series that we do every Monday, we talk about the positioning of traders on the COT report, or the commitment of traders, and how the bullion banks are positioned because they're considered the sharps of the market. They tend to move ahead of big market swings and really show what the market is about to do, the history of doing that. But before we get into that, we're going to talk about something that recently happened with regards to a fine of one of the big swap dealers across all the commodities markets. That would be Goldman Sachs. Here in Yahoo Finance in September, this was reported that, quote, the U.S. Commodity Futures Trading Commission on Friday ordered Goldman to pay a $30 million penalty for failing to diligently supervise its swap dealers' activities and for failures relating to swap date reporting and so-called pre-trade mid-market marks. The penalty comes on the heels of an earlier $3 million fine Friday by the CFTC, which faulted Goldman's surveillance of customers' large position in an oil futures contract in late December 2017. The CFTC said that one of Goldman's automated internal controls malfunctioned and didn't properly suspend the transaction. Goldman didn't admit or deny the allegations in settling either of the CFTC cases. Quote, we are pleased to have resolved these matters, unquote, the firm said in a statement. The CFTC, according to Yahoo Finance, also imposed a $15 million fine on JPMorgan Chase & Company and an $8 million fine on Bank of America Corp. Over lapses that impacted the reporting of millions of swap transactions. The story goes on to note that Bank of America did admit to the allegations as part of its settlement over swaps reporting, as did JP Morgan. JP Morgan declined to comment. Bank of America didn't immediately respond to email requests for comment sent outside of normal business hours. The fact that a lot of times they don't admit fault is going to be a big part of our reporting today. I'm foreshadowing what we're about to go over next. I wanted to highlight the Commodity Futures Trading Commission, which is the regulatory agency over all commodities in the U.S. and therefore any of the banks participating in the swap agreements. And here it's led by Chairman Rostin Benham. And we're going to highlight one of the commissioners, Commissioner Christy Goldsmith Romero, for her recent remarks over the settlement of these types of cases through the CFTC and her concern over Goldman specifically, and some stories highlighted. At the very end of the presentation, I'll give you the links to all of this if you guys want to go look over that yourself. So don't worry about where we got the information. We'll provide that information to you. First, we want to highlight Christy Goldsmith Romero. She was sworn in as CFTC Commissioner on March 30, 2022, as you can see right here off the CFTC website, after being nominated by President Joseph Biden in September of 2021 and unanimously confirmed by the U.S. Senate. So we know that she is one of the commissioners of the CFTC. Recently in September, she issued a report called Over and Over Again, Goldman's Corporate Culture of Violating Federal Laws, Getting Caught, and Settling Federal Enforcement Cases. Christie goes on to note on the CFTC website, quote, as a longstanding federal enforcement official, I'm significantly concerned that Goldman is a repeat defendant in federal enforcement cases. Goldman has a long history of violating federal laws, getting caught, and then settling with federal agencies. Not only is Goldman a repeat defendant in CFTC enforcement actions, including some brought before my tenure, it has been the defendant in many other federal enforcement actions by other federal agencies. That includes 2 actions brought by the Securities and Exchange Commission in the past. Before my tenure at the CFTC, I oversaw an investigation of Goldman in my capacity as a Special Inspector General for TARP that resulted in a Department of Justice civil action where Goldman admitted to fraud in connection with its sale of toxic residential mortgage-backed securities that contributed to the 2008 financial crisis, a case where Goldman paid more than $5 billion, according according to Christie at the CFTC. It goes on to note, these enforcement actions evidence Goldman's culture of non-compliance. Instead of creating a culture where Goldman invests in stronger controls and supervision, and then regularly reviews these controls and supervision to ensure it's not violating the law, Goldman has created a culture of being a repeat federal defendant. I'm concerned that each settlement for each specific illegal act may be viewed by the defendant in a silo without painting a larger picture of failure in corporate cultures. So talking about corporate risk management and compliance, she's saying there's a failure in Goldman based upon all of these prior issues. That publication of CFTC goes on to report, quote, the violations of law found by the CFTC in this case are serious, pervasive, and persistent, evidencing widespread problems in Goldman's culture as a swap dealer. Goldman continued this illegal activity for many years, the whole time that Goldman has been provisionally registered with the CFTC as a swaps dealer. Again, I'm going to tie this into the gold market here in a moment when we look at the Office of the Comptroller of the Currency report, but let's continue what she's saying about Goldman. Down here, highlighted in red in the middle, continuing from the CFTC issued by the CFTC commissioner. Goldman failed to accurately and timely report a significant portion of swap data for at least 20 million swaps to a swap data repository that helps the CFTC identify systemic risk and conduct market surveillance and enforcement. I want to know that I interviewed at Silver Symposium over a year ago, about a little over maybe 13, 14 months ago, out there in Washington. I interviewed the gentleman that purported to be the guy that was doing the surveillance of these types of things for the CFTC across not only gold and silver, but all of its commodities trading. And the gentleman went on to say that they received data from the traders themselves and that they analyze that data and they pass it on to enforcement. He's not sure what they do when it gets to enforcement. It's siloed. So even within the CFTC, their review and their enforcement areas of compliance are siloed. And I went on to note through independent research, through a CFTC publication, that the CFTC relies on some of its traders to provide data. So that's the significance of that first point here on this screen, is that the CFTC does not have a completely independent set of data that it should be getting from the commodities exchange run by the CME Group. That's a weakness in the overall enforcement and surveillance activities of the CFTC. It needs its own completely independent, and this report basically edifies what I said last year when I did that report. All right, second bullet point here from the CFTC, continue to quote, for 9 years and on more than 1 million occasions, Goldman failed to provide pricing information or provide inaccurate pricing information to potential counterparties before entering a swap. The pricing information, called mid-market marks, allow potential counterparties, including, for example, municipalities and pension funds, to see an approximate measure of the objective value of swap prior to adding the swap dealer's markup. You'll see when we get into the data, and I report every Monday on the weekly market wrap-up when I go over the gold and silver markets, that the other side of the bullion dealer trades are often these types of entities. They're financial houses, there are other reportables, those are wealthy individuals, family offices, it could be municipalities and pensions, those types. So if they're misreporting the data and they're trading on the opposite side of these groups, as we can see on the Commitment of Traders report, then it goes to show, and I've said this many times, that I think that their data reporting may be leading the other sides of these trades into bad trades. And that seems to be indicated by this commissioner on the report. Going on to quote, Goldman failed to have risk management policies related to clearing, which I noted in my interview with the CFTC gentleman that was responsible for that surveillance. It says here, the final quote, Goldman failed to notify the CFTC and National Futures Association, NFA, about material changes to its assessment of initial margin requirements. Moving on to the last part of that particular report there at the CFTC, according to Christie, quote, I cannot support the proposed settlement because I do not find it to be strong enough to achieve the enforcement goals of justice, accountability, and deterrence. This is not the first time that the commission has charged Goldman with failure to supervise its swaps business, which means that Goldman is a recidivist in violating that specific law. Here, the violations occurred for more than a decade, even as the defendant settled other CFTC enforcement actions. Continue to quote, to achieve justice and accountability for corporate governance failures, I would have wanted to see the undertaking of the settlement for escalation of Chief Compliance Officer annual reports, NFA and CFTC examination reports, and an organization chart of reporting lines at least annually. This would ensure that those in the C-suite are held accountable and have the necessary information and attention they needed to change the culture and compliance and accountability. It also facilitates the CFTC holding management accountable. It goes on to quote, while I appreciate that this case, the commission imposes a $30 million penalty, which is higher than other swap data reporting cases, I do not believe that is high enough to deter the repeat defendant from violating the law again. I agree with my colleague, Commissioner Johnson, with her concerns in an earlier case this summer against Goldman Sachs. And what also goes on to report here is overall that there is a failure of the participants in this market to regulate their own activities, to provide truthful information, and that the fines are not a deterrent. In an earlier letter in September 19, 2022, about a year ago, Christy Goldsmith-Romero, a CFTC commissioner, goes on to note the following quote, I have deep concerns about continuing the Commodity Futures Trading Commission's, CFTC's, long-standing and routine practice of not seeking admissions of wrongdoing when settling the overwhelming majority of enforcement cases, which has resulted in routine civil settlements in which the defendants, quote, neither admits nor denies wrongdoing. For this reason, I recently voted to concur and not simply to support settlements with undisputed facts of egregious fraud that victimized retail investors and had other aggravating factors. My concurrences reflect that I support resolution in these cases to the extent that they be obtained the same or nearly the same relief the CFTC would expect to obtain a successful trial, including restitution for victims. Yet I do not support allowing these defendants to settle without admitting their illegal conduct. And if you read further down in this report, and again, I'll give you the link at the end, you can see that she has proposed an alternative measure. This is a year ago, which I don't think has been adopted because she's still complaining about it, but an alternative measure of doing this called HEAT. And she wants retail investors, i.e. you and me, everybody that trades off of these positions, not only in gold, silver, but all the commodities, to have restitution and also admission of wrongdoing by what's going on. So these firms are not admitting wrongdoing. That's an issue with potentially going into a RICO charge or something along those lines. I'm not sure if that's the correct one, but enforcing a bigger issue around how these firms trade and further getting actual dollar amounts paid that would be much higher to rectify all of the damage. And if you look at the damage done in the commodities markets with these types of situations, it's way more than they're getting fined. In other words, if they actually had to be held accountable for all the damage done in the market, it would actually cause these participants maybe to stop doing it because it would be so much more that they would lose money. Many of us in many prior reports of what's going on with JP Morgan and a lot of these other participants in the news, it's been noted in those reports that the amount of fines don't even cover the amount of money they're making. So they could be making billions of dollars and paying millions of dollars of fines, and it doesn't deter them. And that's what this commissioner, Christy Goldsmith-Romero, is noting in her September 2022 report. Well, what about gold and silver? Here's a familiar chart for those of you that follow me. This is the CFTC COT report for October 10th, 2023, the latest one available at the time of the reporting. And I've highlighted the swap dealers or the bullion banks reportable positions in gold. You can see that there are 163,620 positions short to 91,619 long. And you can see that they're taking the other side of the trade from who is long, the other reportables, the pensions, the financial houses, the things that Christy Romero Smith was saying need to be compensated for their losses because they're taking the longs. The other reportables have 126,398 longs in gold. And the managed money has 93,934. So these are the types of groups that have restitution over these types of trade in the commodities markets. And at the bottom, you'll see the percentage of open interest held by indicated number of largest traders. The the shortest traders own about 30% of the total short trade, and the 8 largest traders own 47.5. Now I'm about to show you information from the OCC, which points out who are the largest players in the derivatives complex overall, and we can impute from that more than likely these are also the players in the gold market because the CFTC doesn't give us that information. But if you look at the sheer size of the 4 largest participants, they own almost all of the derivative exposure across the derivatives complex, including commodities. So it's very easy to then draw the conclusion that Goldman is one of these, and so are these other entities. According to the Office of the Comptroller of the Currency quarterly report, the dominant banks own all this. The top 4 own the overwhelming amount of swaps exposure as well as all the derivative exposure. You can see in the orange. Total swaps is the second down on the bar chart, and it looks like they own over 90%. And if you look at the top 4 in total swaps, it's 128 trillion compared to all other banks participating 18 trillion. 128 to 18. That's about a 6-to-1 ratio, maybe a little over a 6-to-1 ratio. The top four concentrated position over all of the other bank participants. We know that the top four is dominating all of the derivatives markets, including what goes on in the COMEX in terms of gold and silver and all of the other commodities, by the way, oil, sugar, and all those other things. Who are those banks? As reported by the Office of the Comptroller of Currency in the graphic I'm showing you, it's JP Morgan Chase Bank, it is Bank of America, it is Citibank, and of course, Goldman Sachs, who we've been talking about at the beginning of this report, Goldman Sachs. On another chart within the Office of the Comptroller of the Currency report I'm showing here, there is a reporting change that highlights the explosive growth in precious metals derivatives. Now, if you read the tiny text at the bottom, it basically says that they pulled these out of like currency exchange instruments or exchange traded exchange instruments and pulled precious metals out as its own category. And as soon as they did that the last 3 years, you can see the explosion or the overall amount of just ridiculousness of how much we have in precious metals derivatives by maturity. And most of them are just about a year. Why a year or less? Why a year or less? Because it allows these banks to move in and out and make money on very short-term trading. And again, what we saw with the reporting from Christy Romero-Smith, a commissioner with the CFTC, this is how they make their money, and they're not paying real losses to those whom they affect. And she proposed the heat standard in order to make them do that so that they would actually pay back all the money that they may have caused damage to by, one, holding the shorts, and two, providing that mid-market data that's not actually correct and maybe leading people into positions that's not advantageous, but maybe allowing the banks to take advantage of the market. Because think about it, they're the biggest participants. They're also providing mid-market data to the other side of the trade. Seems like it could be a rigged system. I don't know. I'll allow you to determine for yourself. Well, now we're pulling information from Gold Charts R Us, a popular, very good source of information for many years on the market about the positioning in the gold markets. This is the gold COTS disaggregated futures. And I've got highlighted for you in the middle section, middle right, highlighted in gold, the amount of the exposure for the swap dealers. You can see in 2019, they actually exploded the amount of short positions in that bright green color that they hold in gold shorts. Again, in 2019, they exploded, the bullion banks or the swap dealers did, the amount of short position highlighted in green there. We know that they're the biggest shorters. We also know that they are because it's reported by the Office of the Comptroller of the Currency report in these previous slides that I've shown you. And then it's concentrated in the top four, as you can see in this chart in the bottom of this slide. So putting all of this information together, it's easy to note that the top four, which would be JP Morgan Chase, Bank of America, Citibank, and Goldman Sachs, own most of that bright green, because another concentration is in the top four, according to the Office of Comptroller of Currency and other reporting we get from the CFTC COT report, which I've already shown you in this presentation. So their net positions in gold have been short, but something I'll show you is a reversal. And I think that reversal is indicating we're about to have a big change in the gold market. And that's going to lead into my report on what's happening in gold, physical gold, and the markets. You guys want to stay to the end of this presentation for that, because I've got data from some wholesalers, which I'm just going to give you, or basically narrate to you. I'm not going to show you charts. Okay, direction of concentrated shorts since 2019, that same time frame, the amount of shorting has exploded. And you can see from the swap dealers here in the middle, I've highlighted in red, the amount of short position went from a net long to a net short position for those bullion banks. But you see a reversal. You see a temporary reversal in 2022 leading up to 2023, and then back down net short. And then as soon as the banks crashed in May, you see it going long again. Now, if you look at the overall wedge shape I've drawn for you and the pattern, it looks like we're about to have basically a double top in short positioning. And if it continues through that red line I've graphed, it means they're likely headed to a net neutral position and a net long position. That's what I'm following. The last bit of that data in the middle on the far right indicates they may be going long. They may be reversing their short positioning. I've got more data for you on that. This is COMEX owners per ounce. This shows the amount of open interest or open contracts on the derivative market for COMEX. Again, if you want to know what that is, watch my Monday videos, Weekly Market Wrap, where I go over exactly what all this means in detail. So I'm not going to do that here. But basically, we know, you guys have been watching my channel, that the amount of open interest on COMEX dwarfs the amount of actual ounces available for trade. It's a speculative market. It's a paper market. Well, here we can see that as the gold price has risen in that same time frame since 2019, that the overall amount of open interest has collapsed. There's less amount of contracts on the COMEX per gold ounce because the gold inventories increased through 2021 and the amount of open interest has fallen. And you can see since about 2020, 2021, the pandemic started, that the amount of people that could claim the amount of ounces on gold has decreased. Not only have the overall amount of short position is it decreasing, but the amount of owners per ounce, derivative paper contracts per ounce, is decreasing. That means when push comes to shove, there are going to be more people able to pull that gold off of the COMEX. And I think what this highlights is that as the price has risen and as the bullion banks have gone net long, that they're going to want to take gold off the COMEX, and that they have been taking gold off the COMEX. We've shown the chart on Mondays every single week that since the beginning of 2021, about 2.5 years, that gold has been flowing out not only the COMEX, but off of worldwide markets. And they're doing this through the derivative complex. This is how they're doing it. They're using these positions on COMEX to pull that off. And I think this is portending a big upward price move in gold, because as they reduce their short positions and they take the gold off, that gold price eventually is going to explode. Why? They're going to unwind their short positions. The short positions have been to be able to get gold at a cheaper price. Whoever's getting that gold ultimately from the bullion banks, whether it's themselves or the people that they're trading for, they've gotten it cheaper. And as the gold price is rising, they've been unwinding those gold positions, especially as of late, especially as of May when we had the bank failures. They've been unwinding their positions. So what are my conclusions? Since 2019, the overall amount of open interest on COMEX and gold has fallen. The amount of swap dealer or bank shorting on gold has exploded. But as soon as the 2023 bank collapses occurred, that trend reversed. It completely reversed. The banks are slowly moving long gold, as I've been reporting on our weekly market wrap-up for the last couple of months. And I expect the move covers a large potential upcoming move up in the price of gold. And here, lastly, is a chart from YChart showing the COMEX gold future swap dealers, the banks, long positions. And you can see at the right, as of the last few months, they've been moving long very rapidly. Now, they're not as long as they were earlier this year, but they were shorting gold after the bank failures occurred, ostensibly to bring the gold price down so they could get the gold out, or their clients could get the gold out, I'm suspecting. Okay, because we saw the gold flowing off at the same time that the shorting exploded. But now that shorting trend has reversed, and it looks like they're moving more towards net long. They're not there yet. They've got some time to go, but the long interest in the swap dealers is increasing. And this is important. Now, here are the references. And as I leave these up on the screen, I'm going to bring you what I'm seeing in the wholesale market. Now, I'm a dealer. You can see I'm broadcasting up my store. If you come into my store, you'll see this same backdrop here in Grapevine, Texas. You can go to www.goldsilverpros.com, which I'll show you in a moment, and come into the store and order things, or go to the website and order things if you want. So being a dealer, of course, I have access to several wholesalers in the area and several across the U.S. where I source the gold and silver. What I'm seeing in my store is over the last month, gold sales are eclipsing silver sales, and silver's cheaper. And this is very abnormal for gold ounces to eclipse silver ounces, gold being much more expensive than silver. People really have to want the gold. And we've sold more gold in the last 3 to 4 weeks, last 3 weeks specifically, than we have silver. We've been selling gold, gold, gold. People have been interested in gold. Part of that's because of geopolitical concerns. Part of that is also just because I think people see gold as long-term insurance, maybe a little bit more than silver. Silver is a little bit more speculative, and people are moving gold along with the bullion banks and their clients, and the wholesalers are running out. I recently made a trip to a wholesaler here in the Dallas-Fort Worth area, up to their window and said, hey, I want a bunch of gold. And we had pre-ordered some. And they said, you're lucky you got the last one of this and the last one of that coin. And they're out, man. And they're reporting up to 2 to 3 week delays on very popular issuances. It's getting harder and harder, for example, to get American Gold Eagles. We had some in stock. We're sold out. Most of my wholesalers don't have them. So what I have been selling are other gold coins and gold bars. I have access to a lot of gold bars, which I'll show you here in a moment. But overwhelmingly, 2 of my wholesalers are just about out of the popular gold sovereign coins. They have a few left, but not a lot. And when I talked to each one of them, they said, you know what? Gold at the wholesale level has been what people have been buying. And that's a reversal. The first month we opened the shop, it was silver, silver, silver. I sold an absolute, ton of silver out of our inventory. Now it's been mostly gold, and the silver has faded. Silver sales have come way, way down. We've had some people interested in silver, but it's been gold, man. The last 3 weeks have been dominated by gold. We've sold gold bars. We've sold gold coins. We've sold, whatever form of gold you can have, to where I'm almost out of gold in the store, and I'm trying to source more and having to go to many more places to get it. But we do have some available, and I wanted to highlight that for you guys. So we're going to talk about a way that you can get gold here at the website because we do sell it. And so I'm going to share with you our individual website. This is Gold Silver Pro's Bullion store. You can simply go to goldsilverpros.com, as you can see highlighted up here. And I've got two different areas highlighted for you. One, if you go to more and click on exclusive volume pricing right there, you can get, if you have a larger order every single day, what I do is I scour the wholesale market plus what we have in the store, and I put out volume pricing. So if you buy at least 2 ounces of gold or at least $1,000 worth of silver, at least 2 ounces of gold or $1,000 worth of silver, these are the prices. They change every day. So by the time you watch this, you know, it may have changed. You have to check back every day, but this is discounted. This is as cheaply as I can possibly bring it to you and, you know, make any money to help cover the shop whatsoever. If you buy in a little bit of bulk, okay. If you just want, if you want access to bars, which I actually have more of, because remember, a lot of these gold coins are starting to run out. And I expect sometime this year, we might have a little bit of a gold shortage. I think we're at the beginning of the gold coin shortage. The other way to get it is to go to bars. So we have a couple of popular bar issuances here on the website. If you buy in bulk, you can get the 5 gram from Kinesis or the 10 gram. And these are good discounted prices. These are considering that they're fractional gold. They have really, really good prices. And if you go to the gold coins and bar section of our website, well, we have the individuals available as well. So if you wanted to get just a 1 gold bar, or if you want to just get, you know, 1 gram or 1 5 gram or 1 10 gram, you can do that as well. They're available on the website. Or you can go for the gold coins or the silver coins, which we have discounted every day. We do that on a volume basis to try to bring you discounts. Now, on that volume basis, I think we're beating most of the on-right retailers, if not all of them. We check prices every day. And we're beating a lot of the local coin dealers here in Dallas-Fort Worth. We try to do that to bring you the best deal possible. And on the bars, we brought our prices down a lot. We've brought our markup down a lot because we have access to, you know, that inventory at Kinesis. We'll be offering some other brands as well. I'm looking at offering Valcambis and some other brands as well to expand gold bars, because I think gold bars is where it's going to go. We're running out of sovereign coins, and we could have a shortage this year. We already have a shortage right now in the DFW area, but we're talking countrywide. We could have shortages, and gold bars may be the only way that you can get it. That's what I'm seeing. And I think there's a gold shortage. At the same time, I think the bullion banks are slowly moving long gold, because I think that period where they were shorting since 2021, they pulled a lot of availability, a lot of available inventory off the market. And now the wholesalers are having trouble getting it. Not only are they having trouble buying it from people because people are hodling it, they're not getting old years. They're not getting 2023s either. And I see a critical gold shortage coming sometime this year. At least that's what I see at the retail and wholesale level. We'll continue to monitor that. But I think this is setting up for a big move up in gold. I think the enforcement actions of CFTC looks to me like they're probably going to, at some point in time, because of the political and public pressure, they're going to have stronger enforcement mechanisms. I think that's going to help unwind some of this manipulative trade. Now, is it going to happen right now? No. But I think that's a general process that's going to occur over the next few years. I don't know whether it's going to completely monitor that market effectively. We've never had a completely effective derivatives market here in the U.S., especially with regards to the commodities in terms of enforcement. But I think it's going to get more strict. But I think a lot of these bullion banks have already made their money. And I think a lot of that gold's been pulled off the market. And to me, there's at some point in time, there's going to be a gold shortage, at least in popular coin issuances. Now, there may still be some 400-ounce bars out there, but I suspect a lot of them are being melted down and distributed. And bars may be the way to go. If we have that shortage of gold coins, it may be bars. And we definitely have access to that inventory for you here at our website. So if you're interested in that, go look on the website. We've got the individual 1, 5, and 10 gram bars. We've got the bulk bars. And we're scouring all of our wholesalers across Dallas-Fort Worth and everywhere else we can to get you access to those popular gold coins. But just know American Eagles right now, 2023s, are very hard to find. Backdated American Eagles are very hard to find. Krugerrands, a couple of my wholesalers have those on back order. Those are popular. Philharmonics are still available out there. Canadian maples are starting to get a little tight as well. We have a few that we can access, but it's starting to get tight. So if you're interested in those 1 ounce gold coins, now would be the time to do it. And after that, it's probably going to be mostly bars, I would suspect, at least in the short to medium term. At least that's what we're seeing with our wholesalers. All right, this is going to do it. Great report for you guys. Hopefully you got a lot of great information out of this. Remember, Monday's weekly market wrap up, where we cover the major stories, the major economic data, and tell you what's going on in gold and silver. That's basically your news report. And on Thursdays, we do our comprehensive report on something in the industry. Today it was on gold and how I think gold may be about to go long, and how we're having some shortages in popular retail issuance of gold, popular gold coins, and that shift maybe next year over to bars, and it may be starting to get to that point where it's unobtainium, not quite yet unobtainium, but pretty close for gold to be unobtainium. And we know that we've had silver shortages already. So we've had that silver shortage. We may be moving to gold shortage. So if you're looking at this thing about when maybe a good time to buy gold and silver, do your own research. I'm not your financial advisor. That's my disclaimer. I can't tell you what to do, but I'm just looking at the data, and I'm a data head, and I bring you the data, and that looks like what's happening to me. You guys, make your own decisions. But thanks for tuning in today. Appreciate you guys. It's been Rob King, so goldsilverpros.com.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pros supporter membership. We appreciate your support. Keep stacking.